Assalamualaikum warahmatullahi wabarakatuh to my lecturer, Madam Wan Mushira. I have prepared my video presentation of Islamic finance for this semester. Let me first introduce myself. My name is Nurul Izzah binti Badrul Hisham and I am from BA 242 for B. For this assignment, I am required to make a comparison between the conventional concept and also Islamic concepts. So I have chosen Murabaha concept of Islamic finance to be compared with the conventional concepts. So what I have to discuss in comparing both concepts is the value propositions, the structure and operational mechanisms of Islamic financial systems, and also the instruments that have been offered by different institutions. In the first part of this presentation, I would like to explain that Murabaha is one of the popular financing modes used by Islamic banks and financial institutions. It is types of sale which is bai'i, in which the seller reveals to the buyer the cost of the underlying commodity and amount of profit in the form of markup. In this sense, Murabaha is not an interest-bearing loan, which is conventional loan, or in Arabic they call it as qard ribawi, but rather it is a sale of commodity of a price equal to its original cost plus a given markup. A Murabaha transaction is usually executed by the bank purchasing the commodity desired by the client and selling it to him on a cost plus profit benefits. Under this arrangement, the bank is bound to disclose cost and profit margin to the client. Therefore, the bank, rather than lending money to a borrower, purchases the commodity from a third party and sells it to the customer for a higher price. This financing mechanism has nothing to do with the conventional way of financing. If the role of finance is to promote economic growth, to help industries to obtain financing efficiently and cheaply through allocating financial resources and managing financial risk, then the core role of Islamic finance is arguably to provide such economic functions under a unique set of discipline as defined by Sharia. Indeed, compliance with these disciplines is what gives Islamic finance its unique value proposition. Our goal, therefore, must be to ensure that as the Islamic finance industry grows more sophisticated, it continues to support this key value proposition. Sharia compliance is the defining characteristic of Islamic finance and therefore the basics for its value proposition. A Sharia-compliant investment that makes losses after years and years is still a Sharia-compliant investment, but if it breaches the Sharia, it is not Islamic, however, profitable. Now, it is not my intention to explore into the issue of what constitutes Sharia compliance. Rather, my point is that from a regulatory perspective, confidence in Islamic finance depends on certainty, transparency, and discipline afforded by full disclosure, strong governance, and clear regulation. In this part, I will compare on how the client approaches the bank to get finance in order to purchase a specific commodity through Murabaha and conventional way. Through Murabaha, a customer needs certain goods and promises the Islamic bank to purchase the goods if the Islamic bank buys these goods from the supplier and takes the possession. The Islamic bank purchases the goods on spot payment basis from the supplier and takes the possession, either constructive or physical. The Islamic bank then sells the good to the customer after adding its profit markup, generally on deferred payment basis or an agreed period. Lastly, the customer makes the deferred payment to the Islamic bank after or during the agreed period. However, in conventional way, the client approaches a bank to get finance in order to purchase a specific commodity. Next, the interest-based bank would lend the money on interest to the client. Lastly, the customer would go and buy the required commodity from the market. So this option is not available to the Islamic bank as it does not operate on the basis of interest. It cannot lend the money on interest. It cannot lend money with zero interest rate as it has to make some money to stay in the business. In this part, I would like to explain about the misconceptions of Murabaha. So certain misconceptions exist about the cost plus profit contract and conventional banking loans. Many bankers take a view that the Murabaha contract is a synthesized loan, which is a loan divided into pieces based on the risk involved. Well, this misconception is inflamed because Islamic banks are use conventional interest-based benchmarks such as LIBOR, the London Interbank Offered Rate, to determine what profit rate to charge for such contracts. However, conventional bank loans and Murabaha contracts are indeed different. In the Murabaha contract, their financing is linked to the asset purchased on behalf of the client, where no money is actually loaned to the client as happens with conventional banks. The next one is the markup of the asset doesn't increase if the client defaults on the payment installments. In contrast, conventional banks compound the interest and charge a penalty in this circumstance. The next one is economic activity is produced when real assets are traded. Conventional banks lend money to clients without any tangible economic activity taking place. What about the benchmark rates? Because the Islamic banking industry never before had its own benchmark for markups rates, it opted to follow conventional benchmarks such as LIBOR. That doesn't mean that Islamic banks were charging an interest rate. They simply got guidance for what may constitute acceptable fees. However, in late 2011, Thomson Reuters developed a benchmark called the Islamic Interbank Rate (IRBR) that is likely to alleviate this source of controversy. In the last part of this presentation, I would like to conclude based on my opinion. So in my opinion, I would like to say that even if there are some discussions about the compliance to the Sharia while having the Murabaha transactions, since the nature of Murabaha requires that Islamic banks to add some amount to the cost, and that amount may be equivalent to the interest rate of that day, Murabaha is still the most common financing techniques. It would be fair to say that in terms of efficiency, Murabaha is the most simple and efficient financing tools, especially for the people who do not utilize the Western banking tools simply because interest is haram. So that would be all for my presentation in comparing conventional concepts and Murabaha concepts of Islamic financing. Thank you so much for listening to my video presentation. Assalamualaikum warahmatullahi wabarakatuh.